if Facebook goes to $200, again, this person is not worried because he has bought this insurance policy that allows him to sell Facebook at $250. So whatever happens to Facebook, no matter how low it goes, he can sell it at $250. So can you see that the put option is like an insurance policy that this person buys to insure his shares? It's kind of like buying house insurance. Imagine this is your house. You're afraid your house is going to burn down because there's a fire coming, right? So you buy this insurance policy. If your house goes to zero, the insurance company allows you to get $250 value on the house. Does it make sense? Can we follow so far? Okay, great. Now, what happens if Facebook stays at 270, or Facebook goes up in price, or Facebook goes down, but it doesn't go down below 250 by the expiry date? What will happen to this option that this guy buys? You tell me. Let me repeat my question, right? So if Facebook doesn't collapse to zero, right? Facebook goes up, it stays at 270, or it goes down to 260, it goes to 255. What happens to this put option at the expiry date? That's right. That's right, guys. So what happens is this put option becomes worthless. So every day that passes, the put option will lose value, lose value, lose value until the expiration date. This put option from $4, the put option will become worthless. You become zero. Okay. So this person will lose $4, but he's okay because it's like you pay car insurance every year, and if your car doesn't crash, you're okay because you paid that money for protection. Does it make sense? Okay. Now, how about the person who sold the put option? Let's call this person B. So person B is the person who sold the put option to person A. So person B collected this premium. So if Facebook stays at 270 or goes up or goes down, what happens to person B? Person B will keep the $4. Person B will keep the $4. Does it make sense? So person B is like the insurance company. And person A is the person who buys insurance. Do we follow that so far? Okay. So, question for you. Again, person A, what is person A's break-even point? So Facebook has to drop below 250 for person A to be worth its while, right? In fact, Facebook has to drop to 250 minus $4, which is 246, for it to be worth person A's while. As long as Facebook stays above 246, person B will be really happy. Make sense so far? Okay, great. Let's go on to the next slide. So let's look at the two transactions. So again, in the market, you can buy a put or you can sell a put option. So again, the person who buys the put option is the person who buys insurance. Remember that. Yeah, they're buying insurance and they pay the premium. Who collects the premium? The put seller collects the premium. Now, once the person buys the put, he has the right to sell the shares to the put seller at the strike price. In this case, $250. So person A, to make money, he wants the stock price to go down. Okay? He wants the stock price to go down because as the stock price goes down, the put option becomes more and more valuable. Okay? But for the person who sold the put, by collecting the premium, he's obligated to buy the shares from the put buyer at at $250. So for the put seller, he wants the stock price to go up, to stay the same, or even to go down slightly. That's fine. But as long as the stock doesn't collapse, the put seller would receive the premium and the option will expire worthless by the expiration date. Okay, so that's how options work. That's how put options work. So let me give you an example right now of how I use this in trading. Okay, so this is CRM, this is Salesforce, and as you can see, it's on a clear uptrend, right? The 20 is above the 40 moving average, the 50 is above the 150 moving average. So on an uptrend, we expect the price to continue going up, correct? Or, you know what, it may continue going sideways, or it may go down a bit. But there's a strong support here. You can see there's a strong support at 233. Okay? So if you are confident that the stock will go up, go sideways, or go down, but it will not go below this level, what could you do? You could sell a put option way below there at say 215, for example, right? So if you take a look at the option chain, this is the option chain over here. Now, the first thing is, when you sell an option, how many days to expiration do you sell? It's up to you. There's no right or wrong. But normally for me, I like to sell an option between 30 to 45 days to expiration. Okay, 30 to 45 days to expiration. So in this case, I choose to sell the 24 December expiry. So this option I'm selling expires on the 24th of December in 33 days. In 33 days. So I can choose whichever strike price I want. It's up to me. I can choose whatever strike price I want. So I'm going to choose the 215 strike price. Let me say, why 215? Okay. The reason is because of this thing called delta. So I like to sell the option at the delta of 10. Okay, now what the heck does 10 delta mean? Okay, so 10 delta means there's only a 10% chance that CRM will go below 215 at the expiration date. Okay, let me repeat that. So right now CRM is at 258, right? Right now the stock's at 258. What is the chance that it will drop and stay below 215 in 33 days? It is only a 10% chance that it will happen. Now, this is statistics calculated by the software. It's only a 10% chance. So in other words, if I sell this put option, there's a 90% chance that the stock will not go below 215 by expiration, and hence this option I sell will become worthless. And when it becomes worthless, I get to keep the premium, which is $1.96. So I sell this put option, I collect $1.96. By expiration, the option becomes worthless, I keep the $1.96. And I've got a 90% chance that it's going to happen. So the great thing in options is that you don't have to guess what is your chance of winning, because it is calculated from the software and it's based on statistics. It's kind of like an insurance company. They know the probability of a payout in the insurance claim. Okay, so let's look at the chart right now. So again, CRM is now at 258. That's the current price. Okay, so I sell a put option at 215 strike price. And you saw earlier on that by selling this put option, I collect $1.96. Remember, one contract is 100 shares. So in other words, I collect $196. And in 33 days, this option would expire worthless. If the price doesn't stay below that in 33 days. And again, my chance of it staying above is 90%. Okay? Now you can see that in this case, my strike price at 215 is about 17% below the current price. So for the price to go below that, it has to drop 17% in 33 days. And if you buy great companies that are big companies, it's very rare for that to happen. All right, it's very rare for that to happen. Okay, does it make sense? Okay. Now, but you may say, Adam, what if it happens, right? What if the stock price really goes down below 215 in 33 days? What's going to happen? If that happens, then as a put seller, I'm obligated to buy the shares at the strike price. All right, which means I have to buy this company at $215. And if I have to buy 100 shares per contract, I have to pay $21,500. Now, some of you may say, but I don't want to own the shares. I don't have 21 grand. What do I do? Okay. So if you don't want to own the shares, or you don't have the money to buy the shares, if that happens, then you buy another put at 210. Okay. You buy another put at 210 to hedge your position. So it's kind of like you sell insurance, but you buy reinsurance. I repeat that. You sell insurance and you buy reinsurance. So in this case, I sell this insurance policy, I collect 196. But to protect myself, because I don't want to own the shares, I buy a put option, I buy another insurance policy, and I pay $1.50. Remember, when you sell an option, you collect money. When you buy an option, you pay money. But I collect a 196, I pay $1.50, I still make a credit of 46 cents. So we call it a net credit. And hence we call this a credit spread. Let me say, only 46 cents? That's not exciting, right? But again, one contract is 100 shares. So every contract I buy, let me write this down. Okay, every contract that I buy, I will get $46. If I buy 10 contracts, I get $460. If I buy 100 contracts, I get $4,600. Right? So all I got to do is to scale up the number of contracts in order to target the amount of premium that I want to collect. Does it make sense? Okay. So again, you're selling insurance, collecting premium, and buying reinsurance. So what does it mean? It means that I'm obligated to buy the shares at 215. But now I have the right to sell it at 210. So I buy at 215. If shit happens, I buy at 215. I sell it at 210. What's the most I can lose? What is the most I can lose? The most I can lose is the difference between the two strikes, which is $5. I repeat that, the most that I can lose is $5. Now, some of you are thinking, but Adam, I'm only making 46 cents, but I could lose $5. Are you crazy? Are you nuts? Right? You're risking $5 to make 46 cents. Yes, that's precisely what happens if you allow the stock to collapse and expire worthless. You could lose $5. It could happen, okay? But the way I trade it is I will cut loss very early. The moment I see the stock breaking the support level or changing the trend, I will get out very early so that I'll never lose $5. I'm going to show you what I do in a while, right? So if I'm wrong, and will I be wrong sometimes? Sure. It's like an insurance company. Eventually you sell insurance. Eventually, some idiot's going to have a car accident. You're going to pay out more than the insurance you collected, right? But the idea is to manage your trade such that you won't lose $5, okay? The most I will lose would be about $1.40, and that's the max I would lose. And I'm going to show you again how I manage my trade in a while. But most of the time, I won't lose $1.40. I'll only lose like 50 cents or 100 cents, which is $1, right? So generally, what we call this a bull put spread, or we call this a put credit spread. So let me give you the proper definition. So this strategy is called the bull put spread extreme strategy. And with this strategy, I'm achieving between 5 to 15% per month consistently. Okay? So it is a strategy where I sell far out of the money put credit spreads on uptrending stocks at strong support levels. And I sell it at a delta of 10. Again, why 10 delta? Because it means I get a 90% win rate. So this gives me an ROI, a return on investment of 5 to 15% a month with a 90% win rate. So again, the idea of this strategy is to find companies which are on a strong uptrend. And again, we only do this on very big companies, on Facebook, on Amazon, on Coca-Cola. We don't do this on small companies, right? I repeat that. We only do this on really big companies that are very, very safe, okay? Because we know big companies, very unlikely the price will collapse. It will drop sometimes, but it won't drop that much. So when it's at a strong level of support, I sell a put option and buy another put option so that the difference allows me to collect a premium, which expires in 20, 30 days. And the strike price of this put is at least 15 to 20% below the current price. So for it to reach the strike price is very, very difficult. Okay? Now, let me show you my portfolio right now. This was about 2 months ago. As you can see, these are all the put spreads in my portfolio. And so when I sell a put spread, I sell it at 91 cents, for example. Okay? So as time passes, the options lose value. So from 91 cents, it'll go to 80 cents, 70 cents, 60 cents, and 47 cents. So the more it drops, the more money I make. Eventually, when this goes to zero, I will make the full profit. All right, so you can see that this was captured about 2 months ago in my account. So let me show you my account today. This is my live account today, and I hope that I'm connected because sometimes they've got maintenance. Give me a second. Okay, right. So this is my live account as of right now. So you can see currently I've got 1, 2. Let me make it bigger. All right, it's a bit small. Okay, so right now I've got 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. I've got 10 bull put spread positions right now. You can see these are the prices I sold it at. 48 cents. I sold ADSK. Right now it's dropped to 9 cents. So I've made $1,000. Now again, when it goes to zero, I'll make the full premium of $1,500. All right. Chewy, I sold it at 56 cents. It's now dropped to 18 cents. I'm making $1,000. When it drops to zero, I make an additional 500. So on each position, my premium is $1,500. Okay. This is one that I just sold on Friday, right? CRM. Can you see CRM? I sold it at 43 cents. It's still at 43 cents because I just sold it. Okay, so every day that passes, the price will drop. The options will get worthless. When it goes to zero, I'll collect $1,500, or roughly about $1,500, right? So these are my current open positions, and right now you can see my account has gone from 1.3 million to 1.5 million, right? It's about $200,000 in just 2 months. Now, of course, this is a combination of these trades as well as capital gain on the stocks I hold. It's a combination of both, right? But just on these trades alone, I've made over $60,000 in about 2 to 3 months, all right? So this is one account. I've got many accounts. This is my other account over here, which is my other account, which you can see I'm also selling spreads. So I sold on Zoom. You can see Zoom, right? And making 67 bucks on this. Viva, right? Made 300 bucks. And you can see right now what is my percentage profit and loss over here. Spotify, right? I'm making 400 bucks on that. Yeah, and yeah, you can see I enter these trades. That's Facebook making 400 bucks. I've got 200 bucks more to go. And I also trade this on my Think or Swim account. So this is on Think or Swim. And there we go. You can see these are all the trades that I have currently. ADSK. Oops. Right. Amazon, Alibaba, Chewy, CRM. So these are all my open profits, about 1,500. Now this is a much smaller account, right? So I trade this in small accounts, big accounts, and yeah. So you can do it on small account or big account. Doesn't really matter at all. All right. So let me share with you more about how this strategy works right now. Okay. Now, first of all, it's very important that this strategy is only used for large cap stocks. That means big companies. Let me say, how big is big? I only trade it on stocks that have a market capitalization of over $30 billion. Okay, only do this on big companies. Why? Because big companies, and do this on companies that are really strong. Okay, don't do this on small companies, because small companies have tendency to drop really fast when the market collapses, but big companies tend to hold their value really well. Okay. Next, we only do this on stocks where the options are very liquid. There's a high volume of option trades on those stocks. So best to focus on big companies. Next, we only use the strategy when a company has a high IV percentile rank above 35%. Now, what the heck does this mean? IV means implied volatility. Implied volatility. Why? When volatility is very high, options become very expensive. So when you sell the options, you make a lot of money. But when volatility is low and you sell the options, you make very little money. It's not worth your while. So one of the most important things in this strategy is you only do this on stocks with high implied volatility of above 35%. Okay, so how could you check this? Well, there are a few ways to check this. Let me show you. For example, if I go to CRM, oops, and I go to my trade tab, there. Can you see current IV percentile 36%? That's right. So the implied volatility has to be above 35%. Below that, it's not worth doing this strategy. Now, we have our own proprietary software that we have created at Purana Profits that you can see over here. This is the IV rank indicator, and you can see the IV ranks at 36%. All right, so this is our custom indicator that our students will get, and immediately you can see that CRM has an implied volatility rank of above 36%. It's great to sell options on this monkey. All right, so that's what it means. Next, you also ideally want to avoid stocks which are going to announce earnings. Why? Because when a stock announces earnings, there could be a risk of a sudden gap down. Now, of course, it could gap up, but you never know. So to be very safe, you want to avoid stocks that are going to announce earnings. Okay. Next, we only do this on stocks that have a history of not dropping more than 15% in 30 days. There are certain stocks that have a history of dropping a lot. Do not trade on those stocks. Okay? We only trade on stocks that for the last 10 years, they go up very, very consistently and they don't drop that much. They drop 5% at the very most, but they never drop more than 15% in 30 days. So think of yourself like an insurance company. So you're selling car insurance. You don't want to sell car insurance to an 18-year-old who is drunk, right? Because there's a high chance he's going to crash the car, and as an insurance company, you have to pay out a lot if the car were to crash. We only want to sell insurance to people who are between 30 to 50 years old, because normally they are more mature, and these are the people who are more steady and they are unlikely to drive recklessly, right? So the same thing, we only do this on very safe companies. And that's why we always avoid biotechnology and pharmaceutical stocks. One of the most important things, avoid trading this on biotech or pharmaceutical stocks, because these stocks have the tendency to collapse when the drugs fail their drug trial. Okay? Next, so in this strategy, we sell a put at the 10 delta strike price. Now, it doesn't have to be exactly 10 delta. It could be 11 or 12 or 13, but somewhere around 10. And the strike price should ideally be 15% below the stock price. And then we buy another put one strike below that, and we collect a net credit. Now, when you perform this trade, the broker will need collateral from you. We call that buying power. Okay? So the maximum buying power used should not be more than 10 times of the credit collected. So what does that mean? So for example, if I collect $100 in credit, then I have to ensure that the broker doesn't block more than $1,000 in buying power. This is also known as your absolute maximum loss if you allow the stock to collapse to expiration. Okay? Now you may say, Adam, why? Why like that? Very simple, right? Because the way I think about it is, I'm making $100 out of $1,000 in cash that is used for the trade. So what's $100 divided by 1,000? That's right, it's 10%. There you go. So basically, I'm targeting a return on my capital of 10% on average every 30 days. Hence, if you follow this strategy, you're making an average of 10% every 30 days. Now, 10% every month, if you compound that, it's over 120% return a year with a 90% win rate. So it's one of the most powerful strategies that I use to ensure at least 10% return a month. Now, in reality, I get more than 10% a month. I'm getting about 12 to 15% a month. Why? Because very often what happens is I don't have to wait 30 days for the options to become almost worthless. Usually by 20 days, the options will be almost worthless. So I will close the options and sell new ones again. So I roll it a lot faster. Okay? So that's what I do. Let me see if there are any questions coming in. Okay, cool. So let me show you a few more examples of how this is done, right? So let me show you a previous trade that I put on, and this was a beautiful trade because it was a classic textbook example. This trade was on Netflix, and this was back in September. So first of all, why did I do this on Netflix? Because Netflix is a big company, very, very safe company, and you can see on a very nice uptrend, wave up, wave down, wave up, wave down, wave up, wave down. And again, the best time to execute the strategy is when it's at a support level on the uptrend. So right now, you can see it hit the support level. So I was confident that Netflix will go up. Okay, so it would go up, and if it didn't go up, it may go sideways, or it may even come down, right? But I was pretty confident that Netflix would not collapse to zero, because it's a good company. So what did I do? I decided to sell a put option very far away from the current price at 10 delta. So I look at the option chain, and again, I look for delta, and I look for 10 delta. So in this case, at 10 delta, the strike price is at 420. So what does that mean? Again, right now Netflix is at 516, right? It's at $516. I am confident it will not drop below 420 in 30 days, right? And there's only a 10% chance of that happening because of the delta. Delta tells you the chance of that happening, which is only 10%. Okay, so I sell this put option at 420 strike price. Now, how much money do I collect? How much money do I collect, right? So I'll collect between 410 to 490, or a bit 450, right? So it's about that price. Okay, so let's take 440 as an example, all right? And again, I sell insurance, but I buy reinsurance. So I sell the 420 and I buy the 415. So buying the 415 will cost me 390. Can you see that? So I collect 450, I pay 390, right? Collect 450 about there, collect 390. So I get a net credit of 50 cents. I get a net credit of 50 cents. So every contract is $50. Can you see? Every contract I sell, I get $50. But again, what's the worst case scenario if the stock collapses and it expires below the strike price? What's the doomsday scenario? What's the worst that can happen? The worst that can happen is I lose the difference between the strike price. I lose $5 times 100, right? So the worst is I lose $500 minus the 50 collected, which is 450. Now again, some of you are thinking, Adam, I'm risking $450 to make $50. Are you nuts? Well, again, think of yourself like an insurance company. How do insurance companies make money? They sell car insurance and they collect $50, $50 from the drivers, because they know that not everyone's going to crash, right? Maybe out of 100 people, 5 will crash, okay? So when someone crashes, they will pay out more than $50 in claims. But overall, the insurance company will still make money because they keep collecting $50, $50, $50. Once in a while, they have to pay for a claim, right? It's insurance concept. But again, will I allow myself to lose $450? Of course not. Are you nuts? I won't, right? So by managing the trade, I make sure that even if I lose, I won't lose $450. The most I would lose, maximum I would lose, is I'll lose $150. And that's the worst that will happen. Now, out of all the trades I've taken, there's only one scenario where I lost close to 150. In the other scenarios, when I lost money, I only lost $50 or $100. Okay, and I'm going to let me show you my journal. If you're interested, let me just show that to you right now. This is my trading journal. okay? And you can see that this particular strategy, recently I took about 61 trades. Now the ones in green are closed trades. They're already closed, okay? The ones in black are the open trades. So I've got 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 open trades. And you can see it in my portfolio there. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Can you see? It's all there. This is my trading account, and this is my journal, right? So these trades are still open. Now, if you look at my closed trades, the ones in green, how many losses have I had? Okay, and this is even with the recent stock crash that you saw, right? So you can see I had a loss over there. I lost 600 bucks. I lost 400 bucks. Okay, but these are all my winning trades. 1,003, 1,003, 900, 1,006, 800, lost 654. I lost 600, I made 800. So you can see that, yeah, out of 61 trades, I only lost 1, 2, 3, 4, 5, 6. 6 losing trades out of 61. So there you go. 10% lose, 90% win. Now, my biggest loss was in Alibaba. Why? How many of you know that recently Alibaba had a big drop? You all know that? Yeah. So I lost $3,800 on that one thing. Now, so you can see my average premium I collect is 1,005. Okay? And I lost 3,008 on that one trade. So I lost roughly about 2.5 times my credit. And like I said, that is the worst case scenario. Okay? But the other times when I lost, you can see I lost at 2003, I lost 300, I lost 600 because of cutting loss a lot early. So you've got to cut loss early the moment the trend starts to change. Okay? And that's what you learn in detail in this particular strategy. Okay? So let's go back to our Netflix example over here. Right? So again, let me repeat this Netflix example. So currently Netflix is at $500, okay? And so I sell a put at 420 and buy another put at 415. So by selling this put, I collect 440. Buying this put, I pay 390. So I get a net credit of 50 bucks. And what is the chance that Netflix will drop below 420? What's the chance it will happen? Only 10%. So 90% chance Netflix would go up, you go sideways, it will go down, but it won't go down below 420. So I've got a pretty good buffer. Does it make sense? I got a pretty good buffer. So again, my net credit is $50 and the buying power used is 450. That's my maximum risk if it drops and expires worthless, which again, like I said, I'll never allow that to happen. So my return on investment is 11% in 30 days. It's 11% in 30 days. Okay? Now, let's look at the different scenarios. This is the profit and loss graph that you can see for this trade. Now, this trade was entered on the 3rd of September. Can you see? 3rd of September. This is the zero line. Anything above that is profit. Anything below that is a loss. Okay? So the current price of Netflix is 513. That's the current price today. Now, the green line that you see, this green line, is the profit and loss at expiration. What is the expiration date? There, 2nd of October. Okay? So on the 2nd of October, the green line will be the profit and loss on that day. profit and loss today on the 3rd of September is the purple line. Can you see this purple line over there? As we move to expiration, from the 3rd of September to the 2nd of October, we've got 30 days, as it moves to expiration, the purple line would move towards the green line. The purple line will move towards the green line. Okay? So I'm going to show you an example in a while. Don't worry about that, right? So what's the point I'm making? The point is this. Right now, Netflix is at 513. If Netflix drops to about 439, immediately I have to cut loss. And how much would I lose? I would lose $150, which is the purple line. Which is the purple line. Okay? Now, if I wait to the 18th of September, what happens? Notice the purple line has now gone slightly higher. So my cutoff becomes 432. That to lose 3 times my credit, the price has to drop to 432 on the 18th of September. And by the expiration date, which is the 3rd of October, you can see the purple line has become the green line. So the only way I can lose 3 times is if the stock drops to 418. So in other words, as time passes, my break-even point gets better and better and better. And my final break-even point will be below the short strike of 420. Okay? Let me show it to you right now on the trade of CRM. Let's go to CRM right now, right? So again, right now for CRM, let's look at the chart. What's the current price? 258. Can you see that? 258 is the current price. So I'm confident it will go up, you go sideways, it may even go down again. But this is a strong support that is unlikely to break this support, okay? So what I'm going to do is I'm going to my trade tab, and I'm going to look for the option that expires in 32 days, 24th of December, okay? So which strike do I choose? Which strike do I choose? I look at the delta, right? So I choose the 10 delta. Can you see 10 delta there? That's right. So I'm going to sell 215. Sell 215 and buy 210. If I sell 215, I collect $1.96. I buy 210, I pay $1.49. So I collect the net credit. So how is this done? I'm going to put my mouse over here, right click, sell, vertical. Boom, there we are. Sell the 215, buy the 210, I collect $46. What does the trade look like? Let me analyze the trade over here. There we go. So again, look at this date over here. What date is this? This is the 22nd of November, which is today, right? Today. Now, I can't place the trade today, obviously, because it's Sunday. But let's assume that today is Monday. And I place the trade today. And this expires on the 24th of December. Can you see? So there's how many days to expiration? 32 days to expiration. Now, can you see this purple line over there? Can you see this purple line? And the green line. Now, notice what happens as I move the date forward. Look at it. From 22nd November to 23rd, 24th. Now, notice I'm moving the date forward. Notice what happens to the purple line. Can you see what happens to the purple line? The purple line, like I said, moves towards the green line. At expiration, boom, the purple line becomes the green line. And I only lose money if the price drops below 215. I only lose money if the price drops below 215. Can you see that? So what is the chance of that happening? Less than 10%. So if I put 215 over there, boom, boom. This is my danger price, 215. Now, like I said, in reality, will I allow the stock to drop below that and expire? No, I won't, right? So the moment I see if the price starts to come down and it breaks this support, right? It breaks this support, what do you think I'll do? That's right, I'll cut my loss right there. And by cutting my loss, even before it reaches that strike, I won't lose very much. As I showed you in my trading journal, I'm only going to lose maybe 1 time or 2 times or maximum 3 times my credit. Okay. Let me see if any questions coming in. Okay. So here are some important rules in trade management. Usually what happens is that I will tend to close the trade once I get 90% of the profit realized. I never let it expire worthless. I will normally close it just before expiry. Okay. Yes, right. Close the trade latest before the expiration date. But normally, by the time I get 90% or more of the profit in the bag, I would close the trade early. Why? Then I can open another trade. Because remember, as long as I have the trade open, it's using up my cash, it's using up my collateral. So once I've gotten 90% of the money, I close the trade, so I've got money back. I can use it to open another trade. The other thing, if you want to be safe, is to always close the trade before earnings are released, in case the stock suddenly drops because of bad earnings. All right. So by doing that, you kind of like lower the chance of the price falling if you want to be safe. Okay. And again, worst case scenario, for me at least, is that whatever happens, I will always close the trade the moment I lose more than 3 times my net credit. So in other words, if I collected $50 up front, the moment I lose $150, I will get out. That's the max I will lose. And again, has that happened? It's only happened to me once. Only happened once so far, where I lost 3 times my credit. But again, most of the time, I will not lose that much. I'll lose 1 time or 2 times my credit. Okay. Now, some of you may ask, Adam, why do you have this rule that you would not lose more than 3 times? Why not 5 times? Why not 4 times? It's because if you lose 3 times of your credit maximum, your trading strategy would have a very positive profit expectancy. It's kind of like an insurance company. They have done up their numbers and they know that as long as they have a specific win rate with a payout ratio, they're going to make money. So let me give you an example of what I mean, right, guys? So oops, let me get back to the chart over there. Okay. So if I take 100 trades at a 90% win rate, I know that statistically I'm going to win 90 trades and I would lose 10 trades, correct? Okay. Now, each time I win, let's say I collect C. Let's call C the credit I collect. And when I lose, I will lose 3C. Again, this is the maximum loss. Okay, so even if I lose the maximum in this strategy, what happens? So 90 times I will win C, which is 90C. Okay, and 10 times I would lose 3C, which is 30C. Okay, I know this is a bit of algebra, right? Okay, so what's 90C minus 30C? 60C. There we go. All right. So you can see that as long as you take trades with a delta of 10, with a 90% win rate, okay, and even if you lose 10% at 3 times the loss, you will still make 60C at the end of the day, which is a positive expectancy. So remember, in any trading system, you must do the math, just like a casino, that you know that as long as you follow the rules, you will win more than you lose, and you will make a profit consistently. Okay, and that's how I make a profit consistently every single month. Okay. But like I said, I very rarely allow myself to lose 3 times my credit. That is the worst. Okay. Usually I will close the trade the moment the price looks likely to hit the strike price. When there's a change in the trend, or when it breaks the support, I will get out. So instead of losing 3C, I lose 1C, I lose 2C, and that's how I, make a lot more profit every single month. Okay. So like I said earlier on, this strategy is kind of like you become the insurance company. You are now the insurance company, and you're selling insurance every single day, right? Or every single month. You're selling insurance, you're collecting premium, okay, from these drivers. But you know that once in a while, some idiot driver is going to have an accident. So when they have an accident, you have to pay out more for the repairs than the premium that you collected, right? But as long as you know that you're going to collect from 90% and pay out the 10%, like an insurance company, you are going to be profitable. So it's all about managing your actuarial scenarios in your insurance policy, right? So how do I look for these trades? So I look for these trades every day, basically, right? And what I do is I've got a special scanner. And again, when you join our options class, we'll teach you all these things in detail, as well as we'll be giving you all the necessary indicators and software to look for trades and to manage trades. So this is how I look for trades. I go to my scanner, and I already have these set scans. So I will click scan, and there we are. On this particular day, I have got 1, 2, 3, 4, 5, 6, 7, 8 stocks that are potential to trade. Okay, and why are they potential? Because you can see these are my criteria. I only trade stocks above $50. I only trade stocks with a market cap of at least $30 billion. IV percentile above 35, and average volume above 1 million shares. So these are my minimum criteria. And does it mean I'll take all these trades? Of course not. What I then do is I look at the charts, and I want to ensure ideally that it must be on an uptrend. Downtrend, I'm not interested. It must be on an uptrend, and it must have retraced to a strong level of support. And the IV rank, like I said, should be above 35. And ideally, not a must, but ideally, I want to see the Williams percentage R, or you can use stochastics, should be below minus 50. Okay, ideally below minus 50, and if it's below minus 80, that's even better, right? Because this tells you the stock is oversold, and there's a high chance it's going to bounce back if it's oversold. So these are the different indicators that I use for this strategy, all right? So if you look at ADSK, look at the first one, ADSK. Is this a good candidate to trade? Yes or no? Well, let's take a look. Is it on an uptrend? Yes. IV rank above 35? Yes. Is it making a retracement? Right? Wave up, wave down, wave up, wave down, wave up, wave down, wave up, wave down. So it's great to enter the trade here or here. Okay? But the only dangerous thing is that, earnings are coming soon. That's right. Okay, so if you want to be more conservative, you will not take the trade because we want to avoid earnings. Because in earnings, it could drop down, right? So yeah, you want to be safe, avoid earnings. That would be the safest thing. Okay. So another example would be BIIB. Now BIIB, I would never trade the stock. Why? I told you, I never trade biotech and pharmaceutical companies because they've got a tendency. Look at these stocks. These are crazy. Look at that, right? Boom, 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 right? These are really very highly dangerous. So never trade biotech stocks unless you want to commit financial suicide. Okay. If you look at DG, now DG looks very nice, right? Why? Look at wave up, wave down, wave up, wave down, wave up, wave down. So it's at a support right now. Well, it's kind of like broken the support, right? So yeah, not that good, but that would have been great, right? That would have been great. And you can see the Williams R is, oversold. The IV rank is high, so it looks perfect, right? But again, look at it. Earnings are coming, so that's a bit risky as well. So you want all the stars to be aligned, low earnings, high IV, right? Yeah, strong support, and you do this, and you get really, really great results, okay? How about Zoom? All right, again, earnings are coming again. So again, you've got earnings coming out. Having said that, there are times when I will take the trade even if there's earnings coming, right? Why? Because there are certain stocks that I'm very, very confident that historically, they don't move much during earnings. Or even if they do, they won't drop more than 15% during earnings. So there are stocks which I'm very confident and I'll still take it. That's why you have to look at the history of the company to see that historically, even during very bad earnings, the stock has never dropped more than 15%. Now, not that it will never happen, but very unlikely it's going to happen. Okay. So this is a strategy that many of my students love because, again, it's got a very high win rate and very consistent income on a monthly basis. These are some of my recent students sharing. It's Hi Master, Fambang, and Adam sharing my year-to-date result. No words can express my gratitude for all your guidance and teachings. My favorite strategy is BPS, Bull Put Spread, Bull Put Spread Extreme, and the earnings probability spread. And you can see it's up 89% so far for the year. Okay. This other gentleman, right? 6,000 profits from 3 Bull Put Spread Extreme trades I took on 2nd November when markets were falling hard. Great payoff in just 2 days. Thanks, Adam, for teaching us such a brilliant strategy. Okay, this is him again, right? You can see he made total of $10,000 US month to date in October, right? Now, some people ask, how much money do I need to trade options? It depends on the strategy. There are certain strategies you need a bigger account. Like if you sell covered calls, yes, you need 100 shares. If you sell cash secured puts, you need enough cash to buy the shares. So there are certain strategies where you need a bigger account. But the good news is that there's many option strategies that we use that require minimal capital of at least $2,000 or $3,000 you can trade comfortably. So this one gentleman where he said, this is my options trading account. It's a small account. I started with 2,000 in January and added 12,000 later in February. Now it's grown to $50,000. All investors need to understand options. It will help you to minimize risk and maximize returns. If you don't understand options, it's like going to war with a knife and a spear. All right, I'm not a sales rep, and Adam is not my real brother. Yeah, because someone in the chat group asked him, hey, are you Adam's brother? You're promoting Adam. He said, I'm not his brother, right? And yeah, that's his account. You can see his year-to-date profit down there. Very, very impressive. Give me a sec. Let me just make it a bit bigger for you guys. Right there. Year-to-date profit $40,000 just in the last 5 to 6 months. Again, he started with only 2K, he added 12K, and now has grown his account to $40,000 using these strategies. And I can tell you that the person that I'm the most proud of when it comes to options trading is my partner, Patrick. Okay, now, for those of you who don't know, my company, we have been around for 15 years. We started in what am I talking about? We've been around for 17 years. We started in what am I talking about? 18 years. This is our 18th year, right? We started in 2002. We've been around for 18 years. And the person who has been with me since day one is Patrick. He's my CEO. He's the CEO of the company. And he's the guy who has been responsible for building the business. As you know, I don't like to manage people. I don't like to run businesses, okay? I'm an introvert. I like to be alone. So I only like to trade. So while I'm trading the markets, I'm a professional trader and investor, and I love talking. Patrick doesn't like publicity. He doesn't like to talk. In fact, he said, Adam, don't show my picture, please. But I want to irritate him, so I'm purposely showing his picture right now. He's going to be pissed off, and I don't care. Okay? And the funny thing is that in the last 18 years of running the business, he has never been interested in trading. Because he said, I'm too busy running the business, you do the trading, I run a business. But recently, because this strategy is so easy to use, and it only takes a couple of minutes a day, that he started using this strategy as well. And he's been trading this for now about 5 months. And he said, thanks to my partner Adam and our colleagues, they inspired me to start my options trading journey during the lockdown period. Yeah, one big reason is because, see, Patrick is someone who loves to travel, he loves to entertain clients, and he's been very busy for 18 years. But because of the lockdown, now he's at home running the business, he's totally bored. So for the first time in 18 years, he started trading out of boredom, right? And he started with 20 grand. He added more funds as I became more confident. As of 21st November, which is about 5 months since he started, I've made 109,000 in profits with an ROI of 58% based on my investment of $180,000. To keep my life simple, I mainly only use one strategy, okay, which is the bull put spread. That takes 2 to 3 hours a night. Actually, you don't need that much time, right? But he just likes to stare at it. I don't know why. My average returns per month for the last 4 months is between 6 to 8% per month. And this is his screenshot of his portfolio. He was very kind to send to me. As you can see, his overall year-to-date profit, 5 months, $109,000. Just on that one strategy that I showed you, the bull put spread. And now his account has grown to 285,000 US dollars. Okay. Now, what I've shown you so far, I hope it's been useful. I hope it's been eye-opening, but it's only one strategy. Okay. In the options course that is taught by Bang Fang Van and myself, right? We both teach the course together. There are altogether 16 powerful option strategies that you will master. 16 of them, right? So I've just shared one of you. There's 16, okay? That will allow you to profit under any market condition with any asset. So what I showed you today is trading options on stocks. But remember, you can trade options on ETFs. You can trade options on futures like oil, like gold, like silver, like natural gas. You can trade options on Forex, right? So you can trade options on any asset class, and we'll be covering that in the course as well, right? In fact, Bang Fang Van trades options on oil and natural gas as well. I don't, but he does, right? By the way, between the two of us, Bang is the options grandmaster, right? He's like the Batman. I'm like the Robin in the options world, right? So many of these strategies, he invented it, and I learned it from him. So you can't learn many of the strategies out there because it is, you know, his invention, right? So as you know, anything can happen in the markets. The market can be on an uptrend, on a downtrend, or sideways. So in different market conditions, you employ different strategies. Okay. So for example, when the market is on a very strong uptrend and you're very bullish, the market's flying, what strategy do you use? You use the bullish synthetic strategy known as the bull bang. Yeah, it's called the bull bang, invented by Bang, right? Or you can use a bull call spread, which is a debit spread strategy, or use what I call a callback ratio. So there are three different strategies to use when you're very bullish, when you're sure the market's going up or the stock's going to go up right now. But if you're not sure, you are moderately bullish. You think, yeah, it may go up, it may go sideways, I'm not sure, then you use the bull put spread and the bull put spread extreme. Because remember, what I taught you, the bull put spread extreme, we make money even if it doesn't go up. So it goes up, we make money, goes sideways, we make money, goes down, we make money. We only lose if it collapses 15%, right? So as long as we are moderately bullish, we think it's going up, but we're not sure, we're going to win, okay? Now, what if the market goes into a bear market, right? What if we go through a bear market? Now, remember, a bear market only happens once every 5 years. It doesn't happen that often, right? And the last bear market we had was in February this year. So don't expect another bear market for another 4 to 5 years. Right? So it's not going to happen that often, right? But when it does happen, when the market is on a bear market, right, then we use very bearish strategies, like the bearish synthetic called the bear bang, the bear put ratio, the bear put spread, and the put back ratio spread. And again, you learn all this in the course step by step with a lot of case studies, a lot of examples, and we coach you step by step live during the options Telegram chat group, right? Now, if you're moderately bearish, you think it's going to go down, but it may not go down, I'm not sure, use a bear call spread, which is the inverse of the bull put spread, okay? Now, what if the market's going sideways? It's like in a range, going sideways, going nowhere, and volatility is very low. How do you make money? Or it's high, right? You can sell covered calls or use diagonal spreads or calendar spreads, snipebacks and iron condors, and snipex 4B. So again, these are strategies we use when it's going sideways. How about special events like during Brexit, during the US elections, when a company is going to announce earnings? How do you make money regardless of whether the stock gaps up or gaps down during earnings? Bang has invented a technique known as the earnings sniper spread. I love this one. The earnings sniper spread wins 90% of the time as well. It's a 90% win rate, and you make money whether the stock goes up or the stock goes down. Why? How come? Because in the earnings sniper spread, you make money based on volatility. Based on volatility. Remember, before a stock announces earnings, what is one thing that tends to happen? The volatility of the options will increase. The volatility will increase. So this strategy profits from the rise in volatility. We call it your long vega. So regardless of whether the stock goes up or goes down, as long as volatility goes up, you're going to make money, right? And that's the beautiful thing about this strategy. And that is how Bang has managed to double his account in the last, was it 6 or 7 or 8 months? And he had this earlier webinar. I hope you caught it. If you didn't, watch Bang's webinar as well, because he shows you how he employs all 16 strategies in his portfolio. And he switches between strategies as the market conditions change, right? So it's really, really powerful stuff. Okay. This is Kok Yu from Malaysia, recently sent a thank you to Bang. And he said, Master Bang, I want to thank you from the bottom of my heart for your superb teaching and guidance in my options trading journey. He's from Malaysia, by the way. I've been using your proprietary strategies like bull bung collar, snipebacks, bull call spreads, and hedging with bear put spreads. My portfolio year to date is up 40% return. It's a modest in comparison to other students, but I'm happy overall. Iron Shell, Iron Striker, and OTP are the best investments I've made to educate myself on the art of taking on Wall Street, right? A 42% return year to date. By the way, Khoo Yu, I remember he first attended our classes about a year and a half ago. And when he first attended, he knew nothing about finance. He knew nothing about the stock market, zero. This guy is a surgeon. He's an orthopedic surgeon, right? So he knows everything about the human body. He's a surgeon, zero finance. But today, he's beating professional fund managers after taking these courses and being mentored by Bang and myself. And we have got this other lady, Li Fang. She's from, I'm not sure if she's from Vietnam, because I know there are many Vietnamese students who are now all our students have their own favorite strategies. Some of them, they love the bull put spread, which I use. Some of them, they love snipeback. Some of them, they love bull bun. They all have their favorites, right? Okay, so let me introduce you to the courses that we have. We have got 2 courses. Level 1 is Iron Shell. Level 2 is Iron Striker. Now, level 1 has 10 lessons in total, all right? So in level 1, the main objective is you will learn how to use options to hedge your portfolio against drawdowns while earning extra income, okay? So in level 1, you learn the basics of options trading. Now, if you're hearing about options the first time today and you don't understand fully what I've taught, it's normal. Trust me. When I first learned options 15 years ago, I found it totally confusing. Now, maybe I had a lousy teacher. Maybe I'm a slow learner, right? But it took me 3 months to understand how options worked. I was really confused about it, right? But the moment I understood it, I got it, right? My life was never the same. It changed my life completely financially. So it's like, learning to ride a bicycle, right? At first, you wobble, you're not sure, you're a bit scared. But the moment you learn to ride a bike, guess what? It becomes natural, right? You just ride it without thinking about it. Same thing with options. So again, like I said, if you're hearing about options the first time, you're confused, don't worry. I don't expect you to understand everything today because, I've got a short time, I'm rushing through, and it takes time to digest this. And that's why the way we design our courses, we go step by step. And you can watch the videos as many times as you like. You've got a lifetime access to the videos. Anytime you've got questions, you can ask the questions until you get it. Now, once you get it, nothing can stop you. You become unstoppable. You see, stock trading is like you learn to become a soldier. You learn how to find the enemy, how to aim, how to shoot, how to take cover, right? But learning options is like going to the special forces. You're going to commando school, where you're learning all the very powerful weapon systems. You're learning to use the grenade launcher, the claymore mine, the saw machine gun, the Uzi. And with all these weapons, what happens? You become a very powerful soldier, right? Lesson 2, you learn all about how to set up the charts and how to use all the trading tools and trading software that I showed you just now. Lesson 3, the basics of how to buy calls and buy puts. Lesson 4, selling covered calls. This is a great strategy to earn extra income as a stock investor. Lesson 5, how do you hedge your portfolio during the bear market using protective puts? Lesson 6, how to buy stocks at huge discounts using cash secured puts. Lesson 7, you'll be learning about bull call spreads, which are vertical debit spreads. This is another student from Vietnam. His name is Nok. He says, Dear Sifu, I'm Tony from Vietnam. I'm very glad to tell you that since the 104% return for the year, $200,000 account built up. Okay. Lesson 8, you'll be learning about buying vertical put spreads. Some of you, this may sound very alien, like what the heck is a put spread? And again, don't worry. I'm going to teach you step by step. You're going to master this stuff in no time. Lesson 9, you'll be learning about technical analysis to know how to read the chart patterns on when to deploy these strategies. And finally, lesson 10, how to set up your trading station. How to use your trading tools. Give me a second. Yep. How to use the trading tools and the software. All right. This is Mr. Wong SF from Malaysia and Singapore, right? Dual citizenship, maybe. I think it's a PR here, right? He said, thank you, Adam. Yesterday marks my small success after being introduced to stock trading 3 years ago, and I took serious action only 4 months ago, right? Catering my maximum capital and doubling my capital in 2 months, right? So you can see he made 108%, doubling his money in 2 months. And he said that, thank you, Bang, for your options knowledge. For my 100% gain in capital, 65% was from options trading, and the balance was from stock investing. Okay. Okay, so level 2, Iron Striker. So what's the difference? In Iron Striker, you'll be learning a lot of the advanced strategies with an 80 to 90% win rate. So very high win rates, very consistent way of generating income for yourself. So you're going to learn 12 powerful strategies, of which many of them have been developed by Bang himself. So you'll be learning the introduction to advanced options, credit spreads, which is what I shared with you earlier on, all right? Iron condors, which is how you make money in a sideways market, the earnings probability spread, how do you make money from company announcing earnings, long diagonal spread, which is known as the poor man's covered call, okay, long calendar spreads. This again profits from volatility increase and time passing. Synthetic long and short stocks and protective bullish synthetic, known as Bu Bang. This is one of the greatest inventions by Bang Fan Van, and one of the ways that many of our students do really well using the Bu Bang strategy, trademarked by Bang himself. All right, Snipex, and you're going to learn the psychology of and risk management. This is Wally. Do watch his full interview on our website. We've got a full interview with Wally. Wally is from the US, 19 years old, but if you want my 2 cents, I think bull back ratio spreads are paying off. That's one of our strategies we're teaching. Better use of capital than buying stocks allow for better risk management. I've achieved a pretty nice year-to-date return total with the strategy, which also relies on value, momentum investing, Adam, blah, blah, blah. And yeah, he's made a pretty good return. Yeah, 7,000 in a day, you know. Okay, lesson 11, you'll be learning how to put everything together into a profitable options trading business, right? How do you run this as a business where it becomes like a business and you can do it full time? And like Bang Fan Van, as you know, he still has a full-time job in a multinational company, and he also trades options full-time. And I said, Bang, why don't you quit your job and do this full-time? Because he said, Adam, I'll be bored to death, right? I love meetings, I love running management, and yeah, you can keep your full-time job if you want to, if you love working like Bang, and also make a full-time income. So you could, essentially double your salary by learning this, right? Lesson 12, when to use each strategy. when to use the different strategies at different phases of the market. Okay, lesson 13 is the back ratio spread, which is a new strategy, and lesson 14, the earnings sniper spread, which I mentioned earlier on. Lesson 15, the bull put spread extreme. So you can see that you get lifetime access to these videos, and time and again we add new strategies with no extra charge. So you're paying one time for a lifetime of upgrades. It's the deal of a lifetime. No other company or trader or course offers this, right? Most courses out there, you have to pay a subscription, right? And you want to learn a new strategy, they charge you more money, and we don't do that, right? We believe you pay one time and that's it, and for the rest of your life, you get access to the videos for unlimited access, plus every time with a new strategy, you get it for free, right? We don't charge you anything more. So people have said, Adam, it's an amazing deal, right? We've never seen anything like this, and because we want to make sure that you guys get the biggest bang for your investment. Okay, so like I said, all courses and playbooks are on sale. For this particular webinar, you'll be getting the first bonus, which would be our trademark trading tools. Okay, now bear in mind that for these trading tools that we use for options, some of them, they require you to have Windows. Okay, now I'm a Mac user, so to use Windows, I have to use a converter, like a parallel software, which you can use, and you also need Microsoft Excel, okay, and the Thinkorswim platform for certain particular tools that we use. Now, some of you may say, what if I can't use Thinkorswim? I got to use Interactive Brokers, I got to use Tasty Trade, I have to use another broker. No problem, you can still implement the strategies. You can still do that, right? Personally, for me, I personally don't use some of these tools because I tend to trade with Interactive Brokers. And it's fine because I do it manually, which is fine as well, right? So it's not a must, yeah? Now, bonus number 2, you will also get a 3-month subscription to the Options Tactics Playbook, or we call it OTP. This subscription is where you get to mirror Bang Famban's trades live. That's right. So every time Bang puts a trade, you get an immediate alert. He sells a trade, immediate alert. So you get to watch him trade live every single day. And this is a subscription service where you watch how he trades. And you get a 3 months subscription to this for free. Okay? This is Hendrik from Hong Kong. He said, thanks, I couldn't and wouldn't do it without the confidence, guidance, patience, and mentorship from Adam and Bang. I've tried other courses and groups, but none can compare with these two masters. Thank you very much. Lifetime access to our Telegram chat group, where it's 7 days a week, almost 20 hours a day, that you've got questions, we are there to encourage you, to coach you, and to give you feedback. So these are some of the encouraging community that we have, right? This was Joshua showing his trades on Euro, trading the Euro options, oil, and E-mini futures, all right? Trading futures options, right? And you can see how our community are very, very encouraging, right? So here's what you'll be getting for this webinar special. You'll be getting the level 1 course, Iron Shell, 10 lessons, 17 hours of teaching. Level 2 course, Iron Striker, 16 lessons, 24 hours of teaching. So level 1 course, level 2 course, you get the trading tools, the 3-month subscription to the playbook, and exclusive lifetime access to our Telegram chat group. The total value of what you'll be getting today is $8,476 US dollars. And as usual, we've got a crazy deal for you today for Black Friday. 75% off. So you get everything for only $1,469. This is crazy, right? 1,469 US dollars for everything. Level 1 course, level 2 course, 3-month subscription to the playbook, lifetime access to the Telegram discussion group, right? So all you got to do is to click on the link that you see in the chat group. The link will bring you to the enrollment page, and you can enroll using any of the major credit cards or PayPal, or take out your camera phone and you can capture the QR code that will bring you to the enrollment page as well. Okay, so again, those of you who have been around the blog, you have seen other option courses, you know that this is a steal. And just like the stock market, once in a while the market will crash. You can buy great companies at huge discounts temporarily, won't last for very long, so grab it before you never see these prices ever again, and you're going to kick yourself, right? Okay, so again, if you've got questions, my team will be happy to answer all your enrollment questions. And if you've got questions on the strategies that I share, I'll be answering them in a short while after we take a 5-minute break in a while. Okay, now again, besides options, visit our main website. We've got massive discounts off all our courses and playbooks, including our stock trading course, value momentum investing course, forex courses, cryptocurrency. Everything's on a massive sale right now. Okay. This is Philip No. He says,